Greetings, my fellow REIT investors. This week's video, live from my Melbourne home, we're going to examine essentially those REITs that have reported results so far. How have the results season been? Now, this is actually an article from the Business Times which says that more than half of real estate investment trusts that have reported results so far have suffered a decline. Yes, have suffered a decline in DPU levels. Now, what is the impact on the share price? That essentially moving ahead also, we are also looking at which are the REITs that will suffer greater decline in the DPU going forward. Now let's look at basically some of the questions that I have, that I want to share with you in today's video. Now look at this. The first question I asked is that how many REITs so far that have reported results have suffered a decline in DPU level, whether it's half on half year basis or quarter on quarter basis? Yes, you got it right, ladies and gentlemen. The answer is it 40%, 50%, or 60%? How many says 40%? How many says 50%? No, both answers are wrong. Yes, you are right if you have opted for 60%. Oh my goodness. There are only 39 REITs in Singapore. And what? 60% have reported year-on-year or quarter-on-quarter decline at the DPU level. Wow. Then if you are a REIT investor, why bother to invest in REITs, for the DPU when the DPU is on the way down? Now, second questions I asked, ladies and gentlemen, is this. Okay, for all those REITs that reported a drop in the DPU, whether half on year, half on half year or quarter on quarter year, how many say that the share prices of these REITs actually go up, went flat, or go down? Well, the logical answer is down, right? But how much? How many of these REITs reported a decline in the share prices after they report the DPU numbers? Any guesses, ladies and gentlemen? No? Yes? Who says 80%? Who says 90%? Or who says 100% of REITs fall, their share prices fall after they reported a decline in the DPU, whether it is on half on year basis or quarter basis? Yes, you are right, ladies and gentlemen. 100% of the REITs, or near 100%, report results that are share prices that are down after their results are actually out. Well, ladies and gentlemen, you must have hit home the point now that essentially investing in REITs is not as easy as what you think it is. You think that you invest in REITs, you get the DPU, you are safe. The answer is no. Essentially, if you invest in those REITs where the DPU fall on a year-on-year or quarter-on-quarter basis, now they can come out with all sorts of reasons: high interest rates, difficult trading environment, US dollar going up. Now, ladies and gentlemen, that is bullshit. Okay, REITs are meant to thrive, because of real estate market cycles. Yes, real estate market cycles do go down, but essentially, if real estate are essentially defensive, therefore, then real estate investment trusts should logically be defensive for your investment portfolio, for my investment portfolio, right? Well, take some time to ponder, because this is a sacrosanct aspect of what we have been teaching in our investment classes. In fact, if we look at GCP Global Archive, we have been detailing since 2017. Yes. 2017, 2018, 2019, 2020, 2021, 2022, and this year. What have we said? We have said that the movement of the DPU, or the growth of the DPU, the key aspect of the growth of DPU, determines and is the key number one metric that actually determines the share price of the REITs short term as well as in the long term. Well, do look at our GCP Global Archive, where we have documented and actually shared our last 34 years of experience on our monthly articles, as what we have shared with you on real estate investment trust. So do look at them and enjoy them. Now let's look at the prospects of essentially the third question. The third question actually asks you, okay, which REITs actually have reported the positive DPU growth? Well, out of the 39 rates, only 11 rates have reported a slightly better half on half year or quarter on quarter increase in DPU level. Now, that's 11 out of 39 reads. But let's look at essentially, say, two comparisons to actually learn from them, ladies and gentlemen. So let's look at the very first chart. This is actually the chart that is comparing United Hampshire together with a comparable US REIT. This is actually Manulife. Yes, look at the chart, ladies and gentlemen. You can see that United Hampshire, which reported their quarterly DPU at 2.97 compared to the first quarter at 2.91. That is increase in the DPU. How has the share price done compared to Manulife? Yes, you are right. Manulife have reported a drastic drop in the share price, almost 20%. That was because they compared. If you look at this DPU of Manulife, they reported a drop of 16%, down from 2.61 cents down to 2.14 cents in the recent set of results. All excuses are actually given. Strong US dollar, leasing cycles, which are actually not favorable to the REIT. But hey, I thought the management is the one that's being positioned to help investors weather this. Well, that didn't come through in the results. Did essentially the REIT have a REIT-proof method of actually ensuring that earnings deliver to the DPU level? Well, your guess is as good as mine. And look at the tremendous pounding on the share price. Well, Manulife is actually down 20%, whereas the same REIT, with its exposure to the US market, New Hampshire, granted it is actually in strip malls, grocery kind of a REIT, is actually up. So, well, the figures speak for themselves and the charts speak for themselves. So if anything, same exposure to the US market, but different REITs, different fortunes. One shows a higher DPU, one reports a lower DPU. So which is the better fortune, which is a better REIT? Well, it's obvious. The next question that we ask, ladies and gentlemen, which REITs have actually have been the best performing REITs in the first 2 months of this year? Yes, at the end of the prices at end of last year compared to end of February, which you just saw this week. Well, the two outperforming REITs that's up 14% since the beginning of the year are number one, Parkway Life REIT, and two, ARA Hospitality Trust. Surprise, surprise, it's a rare name, but ARA Hospitality Trust has finally turned around with a positive growth in the DPU. And yes, it is a REIT that not many investors actually owned, or it's still considered speculative, but you can see that the improvement in the DPU that we have followed closely because we actually have been in touch with its deputy CEO, that's Marilyn Tan. Help us position in this REIT, and true enough, the share price is up 14% in the first 2 months of this year. Parkway Life REIT, same thing. The DPU actually showed a positive growth compared to the first half of the year, and the share price, as you can see, ladies and gentlemen, has now gone up from a bit slightly below $4 to $4.30, up 14%. Well, once again, higher DPU is a good metric to determine the direction of the share prices or outperformance and underperformance of REITs. Last but not least, let's look at essentially another office REIT. Now, do the comparison between Capital REIT versus Prime REIT. One is exposed to the US office market, the other one is actually in Singapore and principally in Australia. DPU for Capital REIT is actually up in the latest set of results compared to the first half. Well, they actually have 100 million capital gains distribution that they want to share with investors, and that's why essentially the latest results actually show that up. I would expect that the results will continue to benefit from this going ahead in the next few quarters because of this capital distribution. It is actually quite amazing that you are actually having some REITs that are able to share the capital gains with investors, going ahead, whereas some REITs that they have made capital gains from investments, they don't even want to share this gains. Then what happened to Prime REIT? Look at Prime REIT. The DPU is down down 14% in the latest set of results compared to a half-year basis. Look at what happened to the share price. Yes, it's down badly. Well, I recently caught up, well, had a lunch, with Professor Annie Ko, one of my old friend from the academic circle. As you know, she is actually the Professor Emeritus of SMU. I used to teach for the University of Leeds MBA class, the CFA class, as well as actually a couple of academic classes, at various institutions. That was about 20, 30 years ago. In our recent lunch catch-up, I've actually expressed the idea that since you came on as a chairman or chairperson for primary, there are a lot of things that needs to be done, Professor Nico, because there are a few things, that Prime continues to actually exhibit. For example, the latest set of results, what do you see at the headline, ladies and gentlemen? Yes, it shows that the DPU, the distribution for growth, is actually up 2%. But look, imagine in our REITs classes, ladies and gentlemen, we have always been actually share that is very important, that when you look at the headlines, you look at the circular, you look at the presentation materials by REITs, be very, very careful, because REITs only want to present the best of themselves. And true enough, ladies and gentlemen, you look at this slide, the reality is that did primary increase its DPU to you, the share investor? The answer is no. It's shown in the rate bracket. Okay. Did primary shows the latest DPU actually drop or go up? The answer is no. Now, did the distribution, the total available distribution, drop in the first half or second half? The answer is no. It's actually down. But yet, the REIT actually chose to represent that particular aspect, which is not highlighted in red, to show that the distribution actually went up. What is the key thing, ladies and gentlemen? Is DPU, not the distribution, because if you have more shares, it means that your DPU is down, and yet Prime REIT doesn't highlight this. Maybe things will change because the CEO has been changed for Prime REIT. Maybe things will change. The head of investor relations has been changed, and hopefully with Professor Aniko coming on board, things may change. But then again, as REIT investors, do not hang on to hope, because many of those hopes can be false hopes. And at GCP Global Investment Classes, we analyze for you whether this hope becomes reality or really each of this reality is actually hopeless. So once again, till next week, and if you want to sign up for our next investment class on the 27th of November, it's already out. Go to the GCP Global website to sign up and enjoy and trade carefully for your REITs, because that's what I'm guiding you to ensure that those DPU actually translate into better share prices. Once again, till next week, adios amigos.